They told you it was speculation, a bubble, Chinese traders blowing up. Treasury Secretary Scott Bessent stood in front of cameras and blamed the entire rally on speculative excess. Media ran with the narrative. Silver rallied too fast, too high. No fundamentals, just gambling. And when it crashed from $121 to $74 in a single day on January 30th, they celebrated. See, we told you. Speculation always ends the same way. Profits erased, retail destroyed. Back to reality. But here's what they are not showing you. Here's the data they buried under the crash headlines. Silver is trading at around $83 per ounce right now, down from $121, up from that $74 panic low, but up 162% from 1 year ago. Read that again. 162% gain in 12 months. The so-called speculation that crashed is still up 162% year over year. And while the price tripled, registered COMEX inventory fell 75%, not 10%, not 25%, 75%, from a peak of around 346 million ounces in 2020 down to 82 million today. Price up 162%, supply down 75%, and they call it speculation. If this was speculation, if this was a bubble driven by dumb money chasing momentum, why is registered inventory at historic lows? Why did COMEX deliveries in 2025 hit 474 million ounces, more than double the 203 million in 2024? Why are London silver vaults bleeding while gold vaults are growing? The crash was not the end of a speculative bubble. The crash was a desperate attempt to hide a supply crisis that is about to break the entire pricing system. Let me show you the data they do not want you to see. Silver is trading around $83 per ounce right now, recovering from the crash lows. The media called it profit-taking after the late January liquidation. Volatility lingering, markets cautious. But zoom out. 1 year ago, silver was around $32 per ounce. Today, it is $83. That is a 162% gain. The crash from $121 to $74 erased nearly 50% of the value at the peak. Headlines screamed about the destruction. But even after that violent crash, silver is still 162% higher than it was 12 months ago. Triple the 2024 price. More than double where it started 2025. Treasury Secretary Bessent attributed the extreme swings to Chinese traders. A speculative blowoff that had to correct. The narrative fit perfectly. China always gets blamed. Speculators always get blamed. Retail always gets blamed for buying tops and selling bottoms. But the narrative ignores the actual data. The data that proves this was not speculation. This was a structural supply crisis disguised as a futures market. And the crash was not about fundamentals collapsing. It was about hiding how little metal actually exists to back the paper contracts. Now, let me show you what happened to inventory while the price was tripling. Since 2020, registered silver inventory on COMEX has shrunk by roughly 75%, from a peak of 346 million ounces down to 82 million ounces today. Registered inventory is the metal available for immediate delivery against futures contracts, the supply that backs the paper trading system. And it has collapsed by 3/4 in less than 6 years, while the price tripled. Think about what that means. In a normal commodity market, when prices triple, supply increases. Miners ramp production. Recyclers increase output. Inventory builds as high prices incentivize selling. But silver did the opposite. Price tripled. Inventory collapsed. That is not speculation. That is shortage. That is structural deficit. That is demand outpacing supply by such a massive margin that above-ground stockpiles are being drained to fill the gap. And in January 2026, the drain accelerated to a pace never seen before. In just 1 week of January, over 33 million ounces were withdrawn from COMEX for physical delivery. That is 40% of current registered inventory gone in 7 days. Not months, not quarters, 7 business days. On some days, over 3 million ounces left with 0 ounces deposited. Only outflows, only deliveries, only metal leaving the system permanently. And here's the smoking gun that proves this was not speculation. Total COMEX silver deliveries in 2025 hit 474 million ounces, more than double the 203 million delivered in 2024. Every single month in 2025 showed higher deliveries year over year. January higher than prior January, February higher, March higher, every month. This was not a one-time event. This was a systematic shift in how market participants are using COMEX. Instead of rolling contracts forward or settling in cash like they have done for decades, traders are demanding physical metal, taking delivery, removing silver from the vaults, and the pace is accelerating. January 2026 delivered 49 million ounces. In a month, that historically sees 6 to 7 million. A month That is not even a major delivery period. January is supposed to be quiet, a rollover month between December and March. But January 2026 delivered 7 times the historical average. 7 times. And February is worse. As of early February, 18.7 million ounces have been called for delivery from February open interest of 19 million ounces. That is a 98% delivery rate. Not 10%, not 20%. 98% of contracts demanding physical settlement. This is not a futures market anymore where contracts roll forward month after month. This is a physical allocation mechanism, a run on the vault, and the media calls it speculation. Now let me show you what is happening in London because it confirms the same supply crisis. London Bullion Market Association released vault data for January 2026. Gold held in London vaults totaled 958 metric tons at the end of January, up 0.6% from December. Gold vaults are growing, but silver held in London vaults totaled 27,729 metric tons, down 0.3% from December. Silver vaults are shrinking. Let that sink in. Gold and silver are both precious metals. Both saw massive rallies in 2025. Both crashed in late January. But after the crash, gold vaults are accumulating metal while silver vaults are losing metal. If the silver rally was pure speculation and the crash was a return to fundamentals, silver vaults should be refilling. Speculators should be liquidating. Supply should be flooding back into storage. But the opposite is happening. Silver is leaving London vaults even after the crash. And it is not moving to COMEX. COMEX vaults are draining too. The metal is disappearing from the entire Western exchange system. Moving to Shanghai, moving to private storage, moving into industrial applications, leaving the fractional reserve paper trading system permanently. And Shanghai confirms the shortage is real. Physical premiums in Shanghai remain elevated even after the crash. The OR 9999 silver contract is trading above LBMA benchmark pricing. Chinese New Year seasonal buying plus post-crash dip demand is absorbing available supply. If the January rally was speculation and the crash was the end, Shanghai premiums would collapse. Physical buyers would disappear. Supply would overwhelm demand. But premiums are still elevated, still robust. Chinese buyers are still paying above global benchmark prices to secure metal because they know something Western media refuses to acknowledge. The physical market is in shortage, and the paper price is a lie. Now, let me tell you why COMEX deliveries doubled in 2025 and why January 2026 was 7 times normal. Industrial demand, not speculation, not Chinese traders gambling, not retail FOMO, industrial buyers who need silver to operate their businesses. Solar panel manufacturers consuming over 300 million ounces per year. Electric vehicle production requiring silver for battery management systems. 5G infrastructure buildouts needing silver for relay stations and antenna systems. AI data centers using silver for server racks and cooling systems. Medical device manufacturing, water purification. Defense contractors building missile guidance systems. These industries do not speculate. They do not chase momentum. They secure long-term supply contracts to keep production running. And in 2025, they started taking delivery from COMEX instead of rolling futures contracts forward. Why? Because they realized the fractional reserve paper system cannot guarantee physical delivery when they need it. Because they saw the vault drain accelerating. Because they understand that registered inventory of 82 million ounces cannot satisfy 429 million ounces of open interest in March contracts. So they are taking metal now, in January, in February, before March arrives, and the delivery crisis becomes public. The backward rolling pattern proves it. Normally traders roll forward, sell March and buy May, push contracts into the future. But in January, traders rolled backward, sold March and bought January, paid premiums to get earlier delivery, secured metal immediately instead of waiting. That behavior only happens when buyers believe metal will not be available later, when they know the vaults are emptying faster than they can be refilled, when they understand the system is about to break. And here's what makes the Treasury Secretary's speculation narrative completely absurd. The structural supply deficit. Silver has been in deficit for 5 consecutive years. Total cumulative shortfall from 2021 through 2025 exceeds 800 million ounces. That is nearly 1 full year of global mine production consumed from above-ground stockpiles. Mining output is around 800 to 900 million ounces per year globally. Industrial demand plus investment demand totals over 1 billion ounces annually. The gap gets filled by drawing down inventories. COMEX, London, Shanghai, ETFs, private vaults. Every year for 5 straight years, more silver has been consumed than mined, and the deficits are getting worse. 2026 is projected to see a 200 million ounce deficit. Solar demand is accelerating. EV production is ramping. AI infrastructure is exploding. All of those industries need more silver, but mining production is structurally inelastic. 70% to 80% of silver comes as a byproduct of copper, zinc, and lead mining. Higher silver prices do not directly incentivize more silver production if copper and zinc economics do not support new mines. Primary silver mines are only 20% to 25% of global output, and those mines cannot scale fast enough. New mines take 7 to 10 years from discovery to production. The supply cannot respond to surging demand, so inventories drain. And when inventories hit critical lows, the fractional reserve paper system breaks. Now let me show you the real reason they crashed silver on January 30th. It was not about speculation. It was about March delivery. March is the largest delivery month for silver futures. Historically, 30% to 40% of annual deliveries happen in March. Open interest for March 2026 represents around 429 million ounces of claims. Registered inventory will be around 85 million ounces by late February when first notice day arrives. If even 25% of March contracts stand for delivery, COMEX needs 107 million ounces. More than they will have. If March follows January and February patterns with 80% to 98% delivery rates, COMEX could face demands for 300 to 400 million ounces against available supply of 85 million. The math does not work. It cannot work. The system breaks. So they crashed it. They raised margins 36% in 4 days, forced leveraged longs to liquidate, triggered algorithmic stop losses, created maximum fear and panic. The price collapsed from $120 to $74 in one session. Media blamed speculation. Treasury Secretary blamed Chinese traders. Everyone blamed retail for buying the top. But the crash did not solve the delivery problem. It just reduced open interest temporarily, shook out weak hands, bought a few weeks of time. The structural deficit is still there. The industrial demand is still there. The registered inventory is still at 82 million ounces, and March is coming. And here is the evidence that proves the crash was manufactured and not about fundamentals. Physical premiums exploded during the crash. While paper silver crashed from $121 to $74, dealers across America were selling silver eagles for $120 to $150, generic rounds for $110 to $130, premiums of 60% to 100% over the COMEX spot price. If the crash was real, selling driven by collapsing demand, premiums would compress towards zero. Physical would trade at discount to paper. Supply would flood the retail market. But the exact opposite happened. Physical premiums hit all-time highs while paper crashed. Coin shops sold out. Mints could not source metal. Golden State Mint shut down sales because they could not secure supply from refiners. The paper market crashed. The physical market went into extreme shortage. That proves the crash was forced liquidation of leveraged futures positions, not a collapse in actual demand for the metal. And the backwardation confirmed it. After the crash, spot silver traded higher than March futures. That only happens when physical demand is so urgent that buyers pay more for immediate delivery than future delivery, when the cost of waiting is higher than the cost of buying now, when shortage is real and getting worse. Now, let me tell you what Treasury Secretary Bessent is not saying. The market's currently priced in roughly 60 basis points of Federal Reserve easing by year end. Safe haven demand has been fueled by rotation away from dollar-denominated assets, amid growing concerns over policy uncertainties in Washington. Translation: the dollar is weakening. Fed policy is uncertain. Investors are moving into hard assets. That is not speculation. That is portfolio diversification. That is inflation hedging. That is rational behavior in an environment where fiat currency is being debased. But Bessent calls it speculation because acknowledging the truth would mean admitting the dollar is losing confidence, admitting the Fed is trapped between inflation and recession, admitting that hard assets are the only protection. So he blames Chinese traders, blames speculators, blames anyone except the policy failures that are driving investors into precious metals. And the media repeats the narrative without questioning the data. Silver paired earlier losses as profit-taking resurfaced and volatility lingered after the historic late January liquidation. That was the headline after the crash. But within days, demand came back. Physical buying resumed. The structural deficit reasserted itself. And the price recovered because the fundamentals never changed. And here is what happens next. If COMEX fails to fulfill delivery obligations in March, if they invoke emergency powers and force cash settlement, if they change the rules to protect the banks like they did in 1980, confidence in the paper market collapses. Manufacturers who need silver for production will stop using COMEX for price discovery. They will go to Shanghai, London, private deals with miners, bilateral supply contracts, over-the-counter markets, anywhere they can get guaranteed physical delivery. And when COMEX loses its monopoly as the global pricing benchmark, the paper price becomes irrelevant. Only physical matters. And physical is already trading $40 to $60 higher than paper. That gap is not temporary. It is the market screaming that the pricing system is broken, that paper promises cannot be trusted. that the fractional reserve game is ending. Treasury Secretary Besant can call it speculation all he wants, but 474 million ounces delivered in 2025, double the 2024 total, is not speculation. It is industrial buyers securing supply before the vaults run dry. It is manufacturers realizing the paper system cannot deliver when they need it. It is the beginning of a supply crisis that will force price discovery to move from paper to physical. The crash from $121 to $74 was not the end of the rally. It was a desperate attempt to hide how broken the system actually is, and it failed. Because within days, silver bounced back above $83. Registered inventory is still at 82 million. Deliveries are still accelerating, and March is coming. The speculation narrative is a lie. The data proves it. Price up 162% year over year. Inventory down 75%. Deliveries doubled. London vaults bleeding. Shanghai premiums elevated. Physical shortage while paper crashed. The truth is in the numbers. And the numbers say this is not speculation. This is the end of a 50-year fractional reserve confidence game. And when March arrives, the world will see what happens when paper promises meet physical reality.